As I'm sure all of us are aware, the US stock market's been more or less a roller coaster this week, as panic over a new COVID variant seemed to really spook the markets. Last Friday, the Dow Jones plunged over 900 points and the S&P 500 wiped off over 2% of its value. That trend also continued Tuesday with another big sell-off. The primary reason for all of this chaos is because investors worry that this new strain could lead to more lockdowns, restrictions, and overall more difficulty for businesses, leading to slower growth. While we don't know what the future holds or if the market will continue to decline in the coming days, weeks, or months, what we do know as investors is that anytime there's a sharp decline in stock prices like this, that means that practically everything is on sale. For people who are pursuing a passive income strategy by investing in stocks and ETFs, we actually don't care about whether or not a stock's share price goes up or down. The only thing we're concerned about is if there's a dividend cut. That's the absolute worst situation if you're trying to live off of dividends. In fact, for dividend investors, a falling share price is actually a good thing, because during periods where a stock's price falls dramatically, that means we're able to buy more shares of a company for less money. Just as an example, if we have $1,000 we want to invest in, say, Stag Industrial, which is currently priced at $43.45 a share, we'd be able to buy 23 shares of that stock. But if the market continues to decline and Stag drops to $35 a share, instead of being able to buy 23 shares, we'd be able to buy 28. Those additional shares would mean more monthly income since Stag pays on a monthly basis. Now, a dramatically falling share price could indicate that there's serious trouble for a company. I don't want people to assume that just because a dividend stock's share price is tanking, that means you should buy it for more dividends. I'm speaking strictly of whenever the entire stock market as a whole is falling like it has been recently, or like what happened back in March of 2020. Everything from consumer staples to REITs to BDCs fell. I don't think what we're experiencing right now will result in stock prices falling as much as they did back in March of 2020 though. So when the stock market is falling as a whole, there's a lot of high-quality dividend stocks out there that are on sale and offering higher dividend yields. But maybe you're wondering what exactly I like to look for during these opportunities where share prices are falling. I'm sometimes asked by people, what are my buy and hold forever stocks? What companies would I buy no matter how their stock is performing, just like so many other people on YouTube who have made videos on this topic. And the honest truth is, there's no such thing as a stock that I would buy and hold forever and never check to see how they're doing. Even the best companies are susceptible to bad leadership, scandals, or simply not being able to keep up with changing environments. So I don't have any stocks or funds that I would literally buy and not ever look into them over the course of decades. But I do have certain stocks that I have a significant amount of faith in that I continue to invest in even if the stock market gets bad as a whole like it did in March of 2020, or even if we encountered a recession like we did in 2008. So in today's video, I'm going to discuss some types of stocks as well as certain companies that I personally love to see dips in their share prices so that I'm hopefully able to pick up more shares of it at a discounted price. So with that being said, let's go ahead and get started. First off, whenever there's a huge market sell-off like there was in March of 2020, or maybe we'll soon be experiencing something similar, who really knows for certain, it's always a great opportunity to pick up Dividend Aristocrat, King, and Zombie stocks. A Dividend Aristocrat is a company that successfully raised its dividends for at least 25 consecutive years, whereas a Dividend King is a company that's grown its dividend for at least 50 consecutive years, and a Dividend Zombie is a stock that's successfully grown their dividends for at least 100 consecutive years. It's during market dips that these kind of stocks can be the absolute best time to buy for a couple reasons. First off, most companies in these categories offer pretty boring dividend yields. Many companies that have grown their dividends this long are pretty conservative in terms of how much they pay. I'd say the average stock in these categories only yield between 1 and 3%, but when share prices are falling, they can actually fall so much that this can bump up the yields to 4 or even 5%. Looking at a company like Johnson & Johnson, which has an amazing track record of being able to grow their dividends for more than 50 years, has recently only been offering a dividend yield between 2.25 and about 2.6%, which is pretty boring. But if we look back to March of 2020 during the market sell-off, if you would have bought shares of J&J back then, you would have bought in when it was offering a dividend yield of almost 3.5%. It's still low, but I think it's a lot more enticing given their track record. In terms of which Aristocrat, King, and Zombie companies to look for during these market sell-offs, I personally prefer to target consumer staples and service companies that are as recession-proof as possible. These are corporations that are so massive and provide so many essential products that it's incredibly unlikely that they'd ever fold during a recession. Johnson & Johnson is one of those companies, and so is Procter & Gamble. These corporations offer thousands of products that I won't say make them too big to fail, but it makes it extremely unlikely that they would fail. ABM Industries is another Dividend King stock that offers so many services like janitorial and building maintenance, electrical and mechanical repairs, airport cleaning, and landscaping that if they did fall, it would be shocking. It currently yields around 1.64%, which is pretty lame, but in March of 2020, it offered a dividend yield of over 3.5%. And just like that, a boring, low-yielding dividend stock becomes a higher-yielding stock that's really dependable. So it's always a good idea to be on the lookout for strong, dependable aristocrat, king, and zombie companies that are having a massive sale. I'm not saying every company in these three categories are safe though, as some do fall like General Electric. In fact, my favorite dividend stock of all time, and one I like to see sharp price drops in more than any other stock, and this won't be a surprise to most of my regular viewers, is Realty Income, which is ticker symbol O. And I apologize for talking about them again because I keep seeing comments from people saying that they're getting tired of hearing me talk about Realty Income, but especially in this case, I just can't help it. For years, I've been more confident in this higher yielding dividend stock than probably any other company out there. I made a video over a month ago on high yielding stocks, and I couldn't include this one because a month ago its dividend dropped below 4%, which I consider the absolute minimum for a high yielding stock. But as you can see, Realty Income now yields 4.23%, and I honestly hope that its share price will continue to decline so I can pick up more shares of this excellent high yielding growth stock. To date, they've paid 616 consecutive monthly dividends, and they've increased their dividends for 96 consecutive quarters. Since 1994, this stock has offered a compound average annual return of 15.1%, which outperforms the S&P 500 pretty significantly. The company just completed merging with VEREIT in November, and now they have even more properties in their portfolio. And they actually created a spin-off company called Orion Office REIT, which I'm keeping my eye on. I'm honestly hoping that they'll be able to achieve a track record similar to Realty Income someday. The next stock I want to highlight that I love seeing price dips in is Ares Capital, ticker symbol ARCC. This is a business development company that specializes in acquisitions, recapitalizations, mezzanine debt, restructurings, rescue financing, and leveraged buyout transactions of middle market companies. Basically, Ares makes investments into small and medium-sized businesses in order to help them grow, and they receive a share of the profits these businesses generate according to the agreement they make with Ares. A BDC is basically similar to a venture capital fund, only everybody can invest in them. You might be wondering why on earth I'm so interested in a business development company during what could become rougher economic times for businesses, but it's important to highlight a few things that make Ares stand out from nearly all other BDCs out there. Unlike some BDCs, Ares was able to survive the 2008 financial crisis, but they did have to cut their dividend by about 16%. Now, pretty much all BDCs had to cut their dividends during this time. I don't recall seeing one that didn't have to cut it, but a 16% cut is actually pretty mild compared to what a lot of their competitors had to do. And they have some of the best dividend growth within the BDC sector and just recently increased their dividend distributions back in September. Oh, and they also made it through the pandemic plunge without cutting it either, unlike some of their competitors. So in terms of dividends, Ares has shown to be one of the strongest companies in this high-yielding sector. They're also the largest BDC out there with an investment portfolio of over $18 billion and to date have 371 investments. There can definitely be a lot of strength in numbers when it comes to BDCs because it enables them to better diversify their portfolios, which I also really like what Ares holds. According to their latest investor presentation, 77% of their loans are senior secured, which are considered the safest type of debt to hold, but it's not risk-free. They're also heavily diversified across many different sectors like software, healthcare, energy, and consumer services. Finally, Ares has continued to outperform the S&P 500 much like Realty Income has. Between 2004 and September of this year, Ares has outperformed the S&P 500 when dividends were reinvested by about 250%. I won't keep going since I've talked a lot about this company on this channel before, but Ares is still my favorite BDC out there and the strongest in the industry in my opinion. If we keep seeing share prices fall, ARCC is going to be one of my personal favorites. Now this next stock is getting ready to become a dividend aristocrat next year after 24 consecutive years of dividend growth, and that's WP Carey, ticker symbol WPC. This is a real estate investment trust that's one of the largest diversified net lease REITs, specializing in the acquisition of operationally critical, single-tenant properties in North America and Europe. For nearly 5 decades, the company has invested in high-quality single-tenant industrial, warehouse, office, retail, and self-storage properties subject to long-term net lease REITs with built-in escalators. Right now, their stock yields 5.34% and it pays $1.05 per share every quarter. They've continued to increase their yearly dividend distribution amount every year since 1998, and in fact, they've increased their dividends every single quarter since 2010, according to their website. The key that helps this REIT stand out from most others is the kind of properties that they invest in. W.P. Carey likes to focus on recession-proof properties, which include government office buildings, schools, self-storage spaces, among others. According to their website, their total portfolio consists of 1,264 properties totaling 152 million square feet. They have an occupancy rating of 98.4%, which is really good, and 99% of their leases have rent escalations built in, which means that W.P. Carey can increase tenants' rent on a regular basis. W.P. Carey is also a triple net lease REIT, which is a huge plus that a lot of other REITs don't have. A triple net lease REIT is where tenants lease properties from the REIT, or W.P. Carey in this instance, and they also agree to pay all the expenses for the property, including maintenance, insurance, and taxes. This obviously means that the REIT can use this money to either pay more dividends to shareholders or invest in more properties that'll bring in even more income. I'd probably say that the only concern I have at this point is its higher payout ratio, which is at about 90% according to Seeking Alpha. Because WPC is a REIT, they almost all have higher payout ratios than, say, a company like Johnson & Johnson. But I'm not really overly concerned about this for two reasons. First off, WPC has continued to increase their dividends every single quarter. That's not something that they have to do either. In order to become a dividend aristocrat, you only need to increase your dividends once a year. But they're still continuing to grow their dividends at an impressive rate. Plus, looking at their financial statements, we can see that their adjusted funds from operation has continued to move in a positive direction, as well as their book value, which would indicate good growth for this company. Overall, WPC right now is my second favorite equity REIT out there. Before I continue, if this video has provided you with any sort of benefit, I'd really appreciate it if you could give this video a thumbs up and also subscribe if you want to see more high-yielding dividend investing videos, which is what Dividend Bull revolves around. Thank you all so much for your consideration, continual support, and for watching the videos so far. The next stock we're going to look at is ABBV, ticker symbol ABBV. I might get some heat for this pick, but I'll explain my reasoning in a little bit. ABBV is a company that discovers, develops, manufactures, and sells pharmaceuticals internationally. They sell medicines that treat a wide range of illnesses and diseases, including lymphoma, hypertension, migraines, Parkinson's disease, among several others. They employ over 48,000 people globally, and they're headquartered out of North Chicago, Illinois. According to their website, 57 million people use their products annually in over 175 countries. ABBV currently has 22 primary research and manufacturing facilities around the world, and they continue to produce 32 different treatments as of the making of this video. What ABBV also does is use their existing treatments and expand them into new treatment areas, which helps diversify their product line. This company is also a dividend aristocrat, having increased their dividend for 25 consecutive years and counting. It currently yields 4.84%, and it has a very healthy payout ratio of 44.5% according to Seeking Alpha. This is a company that has continued to experience significant growth in revenue since what they sell, medicine, is unfortunately something that people technically can't flourish too well without. But some investors have become more pessimistic towards this company due to what's going on with one of their most successful products, which is Humira. In 2023, AbbVie is going to lose their patent on Humira, which will result in other drug companies making similar treatments, and they'll most certainly lower their prices in order to drive down the sale of Humira away from AbbVie. As of right now, I'm not too concerned about it because AbbVie has other products that are generating revenue, and a couple of them have actually been seeing some pretty significant growth in revenue. I'm probably going to mispronounce these names, but the two products are Venetoclax and Rinvoq that I think will help pick up the slack for the loss in Humira's revenue. It's still a little ways away and we'll have to wait and see, but there's no denying that if the markets continue to decline, that AbbVie's high and safe dividend will be even more enticing. Most analysts I come across also continue to be very bullish on this company, and plus as an added bonus, they just announced that they're increasing their quarterly dividend distributions by 11 cents this January. They have a 5-year dividend growth rate of 17.93%, which is also the best on this list. And these are just some of the stocks that I've got my eyes on to see if they'll keep going down. Don't get me wrong, I'm not hoping for a stock market collapse or anything, but like all investors, I'm hoping to better time the market in order to pick up a larger quantity of shares. I'm not a financial advisor, so be sure to do your own research and come to your own conclusions before investing in any of these companies. Feel free to leave your comments below as far as what dividend stocks you might have your eyes on to see if you'll be able to enter at a discount. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.